Yeah, so today is Monday, July 10th, 2023, 1:41. I'm here with Mark. We're doing a mentoring session, and we're gonna go over today basically an intro to futures trading. That's what I the lesson today will really be about. Some basic things about futures to know, and we'll go from there. So let me start my PowerPoint. I'm gonna share my screen. We're doing screen one. Can you see my screen?
Yes, can see it.
It says introduction to future trading. So like you see in this lesson, we're going to talk about the basic things about futures, to give you foundation is important because I wish somebody sat me down when I started trading futures to tell me, I had to learn all those things along the way, through books, to webinars, to, videos and things like that. So, but when you get the proper order, when you learn in the proper order, it will help you down the road because you're always going to want to keep things in perspective and keep them and keep them in their proper place. So that's really, really important. Now, futures are something you're gonna see the same way you see stocks. New York is like the center for trading stock on Wall Street. Futures, the center for futures is in Chicago. And there's a reason for that. Because that's really this is where the first futures contracts were traded. So what are futures? What are they? So they're basically a contract. It's a forward contract. That's why the term futures. It's a forward contract between one party and another to deliver, to exchange, to have an exchange happening in the future. Somebody's going to give you money and I'm going to deliver goods. This is how futures started. Let me give you an example. Like you and I were, let's say I was a farmer and you were somebody that owns, you make bread, you make bread, but you want wheat, right? To make your bread. So me and you would come into an agreement saying, in 3 months, I'm going to deliver some wheat to you at this particular price. And then you would agree to that. So that way we are both protected. So in 3 months, if the price of wheat is high, you will be protected. Compared to what it is now, it will be protected because you're going to buy it at this price. Let's say the barrel was $10 and we settled on the contract. Okay. Right? Now, in 3 months, the barrel could be $15. It's not your problem. Then you protect yourself that way. Me, as the farmer, I protect myself too in a sense because futures, meaning in the future, I don't know what's going to happen. Today we have a contract for $10. 3 months from now, the price of wheat could be $8. So it's really was in futures were invented as a need to protect both parties, the producer and the buyer, the seller and the buyer. So you have a predetermined price in the future that you agree on. Now, futures contract, they're very after at the beginning, things were being done between the individual parties, and then they went into an exchange. This is where the Board of Exchange of Chicago Board of Exchange, which is still in existence, called CBOT, which is the Chicago Board of Exchange. No, Chicago Board of Trades. Okay, so that's one of the exchanges that futures trading on. There's like 4 major ones. There's the CBOT, which is the Chicago Board of Exchange. There's the CME, which is Chicago Mercantile Exchange, and there's the COMEX, which is the COMEX is more like for metal. This is where gold is traded, all platinum and things like that. And there's NYMEX, which is the energy exchange. So you can learn about those more. I mean, that's one thing with this mentorship. I'll point you in certain things, but some of the research, some of the deep dives you're gonna have to do on your own and come back with some questions if you have. So
I think I understand that the futures contract. The only thing I don't understand is, say you buy a futures contract and then that contract expires. Are you going to get delivery of all those pork bellies? Or
yes, you would. You would if you didn't sell it before the expiration.
where do they deliver them to?
To whatever address you want them to.
And then if they deliver them to you, you have to pay the price that it ended, right?
No, you pay the price that you bought it at. Not the price it ended, the price you bought it at. Remember, this is
Right.
I think this is something you can't miss, because the price that when you buy it, there's an basically it's an agreement. Say, I'm gonna pay that price for it.
Right.
That's the whole purpose of why it was invented. Now the price it ended at is the price that you bought it at. That's just what you're obligated to pay for it.
So if I were to take delivery of like some pork bellies, what would I do with those? Would I try to sell it to Oscar Mayer or somebody?
You and I were speculators, but some people buy pork bellies because they're in the business of buying pork bellies.
Okay.
For example, like I just said, the example I gave you, somebody that's making bread, a company like Sarah Lee, they actually want to buy wheat.
Right.
They actually want to buy flour or whatever,
Or Nabisco, they might want to buy wheat to make their cereal or something.
Exactly. So those companies are actually in the business of doing that. Us who are speculators. So we're always going to try to sell that contract before it expires. And that open another thing. In futures, you're going to have different parties involved. Speculators, you're going to have, I think the next slide talks about that. So before I go to the next slide, so they standardize after a while, I was saying that they go, they were like between individual parties. Then they had to go to the exchange to make it more, so you can have more structure, more rigid, because the contract becomes standardized, meaning there's a certain amount of barrels. Let's say a contract for crude oil, for example, one future contract for crude oil has 1,000 barrels. So each contract is very standardized. They know how much is in there. The expiration date. We're gonna see every contract has different expiration dates and delivery terms. So all those things we're talking about them here for, for general knowledge. And this is something that you gotta understand from as understand where they came from. They not just come out of the air. There was a basic need for them.
Right.
And again, we're talking about purpose. Purpose right now. The purpose of trading futures is the different things. Some people were speculating, like you and I were speculators. We just want to see movement in the contract, and then we can benefit from fluctuation of price movement, whether it goes up or down. Some people, like us, were doing speculation. Some people was edging. Edging meaning, hey, I'm edging. I don't want uncertainty I already have a budget for this much. Let me buy this contract here for $10 a barrel. That way I know if it's 15 or 20 or 30, 40 in 3 months or 6 months. Think about the future contracts too. I don't have to buy a future contract, the next one that's expiring. I can buy a future contracts that's expiring in a year.
Right.
Okay.
Right.
So I can buy a futures contract. It doesn't have to be the next one. So I can buy one that's expiring a year or 2 years. I just lock that price in. Speculators, like we said, like us, we're trying to benefit from the price movement. We're not trying to own it. We're not trying to take delivery. So the edges
but
are
you can if you want. You can if you want to.
You can, but what would the benefit be? If I'm a speculator, I don't want to own anything. I just want to benefit from the price movement. Then that's when you would be an edger if you want to take delivery. Hey, I want to lock in that price. I want to lock in that price. And as a farmer, I don't know what's going to happen, how the harvest season is going to be. If it's going to good or bad. Let me take this let me take the certainty. Let me take the uncertainty out of this equation. That's what futures were really there for. Uncertainty on both sides. The farmer knows how much he's gonna get paid. The commercial hedger wanted to know, hey, this is how much I'm gonna pay for it, regardless of what it is in the future. So that's what the purpose was for futures trading. Any questions so far? So the participant, we kind of touched on that earlier. All they're trying to do is to mitigate risk. They want to mitigate risk associated with the price fluctuation, because we don't know what's going to happen in the future. So that's why the hedger and the farmers, manufacturers, they were there to try to say, you know what, let me get this for now. I don't know what's going to happen next. Us, we just want the price to move up and down, and we're going to try to buy when we think it's going to go up. We're going to sell when we think it's going to go down. And I have no intention of taking delivery. Okay. Now you gotta understand, futures are trading on margin. Think about margin as it's the same thing as leverage. Margin, it's a amount of money that you have to have deposited with the broker for you to trade a certain contract. For example, during the day, for the day trading margin for the S&P 500, most brokers will be $400 or $500. Most of them are $500. Some of them will even give you all the way down to $300. Meaning you have to have this much, at least in your account, to be able to trade that contract. But that contract could be worth 40, 50, 100 times more than the actual margin it requires. So you're trading in the margin. Think about the margin as almost like it's a little deposit that you have with the broker, so you can trade the full contract. Okay,
it's like a fraction. It's like
a fraction of what normally you would take you to buy. Let's say, for example, right now, I believe some with the volatility in the market, sometimes margins go up and down, but the margin requirements go up and down. But at one point, when I first started trading futures, the margin crude oil was $1,000. With $1,000, you can trade a contract which is worth 1,000. Remember, which worth 1,000 barrel, and the barrel of crude oil typically goes about what? Right now it's probably in the last time I checked, it was in the 70s. I haven't traded crude oil in a while, but if I look right now, I can tell you crude oil right now is trading at 73 bucks a barrel.
Okay.
So meaning I would have to have $1,000 really to trade a crude oil contract.
Okay.
So the margin allows you to get leverage, so you can use less money to actually control a much larger position. That's what leverage is. Leverage is a double-edged sword. You gotta be careful with it. It can be really, when the market is going your way, you can take a small amount of money and multiply it real quick, or you can take that money could vanish in a matter of seconds too if it goes against you. So that's why over leverage is a very, very dangerous thing to do. This is what we're gonna get to that when we talk about position sizing. Position sizing, it's really important to know how to size the position based on the amount of money you have in your account. You don't just go and buy 10 contracts or 20 contracts because you have.
Yes.
That's what you want to do.
Yes, I do.
The amount of money you have in your account, and also where your stop loss is going to be, is going to determine all that. So as you can see here, leverage can be a good thing, it can be a bad thing. You got to know how to use it. Any question about margin and leverage?
No.
All right. Contract specs, again, we talked about, the different things. As a matter of fact, what I'm going to do, you can write this down. This is homework for you. Look at the most popular futures contract, the S&P 500, the NASDAQ, the Russell, the Dow, crude oil, gold. I even said natural gas. Let's give you a couple of grains: wheat and soybeans. And then I want to say one more thing would be the financial. Let's go to ZB, which is the 30-year bonds. Those contracts, I want you to get the specs. What are the specs? You're going to find what the size is. Okay. We're going to find what the underlying asset is. We can probably do a Google Sheets. Google Sheets, put what the underlying asset is, what the contract size is, the contract months, the tick size, the minimum tick size, how much it is. Like we know the S&P 500 is $12.50, and the trading hours. It's important to know all those things when you try to trade something, because some of those contracts are, like for example, soybeans. If you're trading soybeans, you gotta know when to close your trade, because it doesn't end at 5 p.m. like everything else. It closes at I think at 2 o'clock or 2 o'clock or 2:30. So
Oh, really? Okay, I didn't know that. Oh, so
yeah, each contract has the time that they close. Most of them close at 5 p.m. But like soybeans doesn't close at 5 p.m. And also there's a break if you're trading it overnight. There's a break. It stop at a certain time. I think it stop at 7 p.m. or something like that. No, it doesn't stop. It start at a certain time, and then resume around 3. I think between 3 and 4 in the morning, and then stop again, and then open at 9:30. So all those things have the contract. So since we've been recording this, you can always go back and see what I'm asking. Again, I'm asking for all those things in the Google Sheets for the most popular contracts. All right.
we can put that together for you for our next session. Yeah.
Yeah, exactly. So successful future trading by starting the thing on market analysis that we do. Now, again, what people do most of the time, they come in and say, what strategy do I need to use? Well, before we can go to strategies, you got to understand, hey, how do I analyze this market? What kind of analysis that this market requires for me to be successful at it?
Okay. Right.
Fundamental analysis, a lot of people kind of glance over that. They're like, okay, I just want to get to the charts. Technical analysis. Yeah, technical analysis is great, but all the technical analysis in the world will not save you if you don't understand what fundamentally is happening in the market. Especially if you're trading things that are seasonal. If you're trading gasoline, there's a futures contract for gasoline. There's a futures contract for oil, like we talked about, crude oil. So you got to understand the seasonality, what's happening with OPEC if you're trading energy, if you're trading the financial things, the economy, based on the economy, like the S&P 500 futures or NASDAQ, what's happening with that particular sector. So you don't have to be an expert, but you got to be aware of what's happening. Back in maybe about 2.5, 3 months ago, NVIDIA came out with some great results. For a whole week, the NASDAQ was being carried by NVIDIA because people were buying NVIDIA, buying all those chip makers. So, the NASDAQ at that time, NQ, and futures, you wouldn't want to be selling that. You wouldn't be buying it. Look for buying opportunities. So you got to know, okay, what's really driving the market. So you got to know all those factors. Technical analysis is great, again, because what I like with technical analysis, it kind of confirm what the fundamentals are doing. Sometimes they're in line, sometimes they may not in line. So you want to really capitalize when they are really lining up. And there's also, I talk about seasonality. You got to understand that. You got to understand the sentiment in general of the market. So you got to be able to handle before you get to strategy. That's gonna help you understand. Okay, what kind of strategy did I use right now? If this market is volatile, so I can probably trade like a trending strategy. If it's trending, I can trade trending. If it's ranging, I gotta trade a ranging strategy. So I gotta adjust my tools based on what the market is doing. So you gotta have that 10,000-foot view of the market before you can dive in. Go try to find an entry. You don't want to go find an entry until you understand what's happening from like fully from a bigger perspective. Risk management. Any question about the previous slide? Let me go back. So you understand what fundamental analysis is? You understand Okay, technical analysis. Looking at the chart, what the patterns are doing, indicators, looking at the historical price data to identify different opportunities. Some people use support and resistance. Some people there's different techniques that you can use when you get to the charts to determine an entry, to determine where price may go in the future.
I understand that.
Okay. Risk management, it's really important. if you don't hear anything else I say today, managing your risk the proper way is what's going to make you successful or not successful. Because if you have a $100,000, $50,000 account and you're trying to risk all of it on one trade, you may work. Hey, the trade worked. You double your money. Okay, nice. But at the same time, if that trade doesn't work, you're gonna blow up your account, and you don't want to do that. What really you should be thinking about every day you trade is, hey, let me trade for another day. I'm gonna trade today so I can trade for tomorrow, because tomorrow the market is gonna be there. So I don't want to be doing everything all at once. And everything I'm talking about here, that was me one time. One time I was always trying to hit home runs. Sometimes you're gonna have to hit some bases, singles and doubles. And every now and again, you're gonna find the next home run trade where you can really capitalize on it and make 10, 20, 30% on your account on one trade. That can happen. But it's not something you're gonna do every day. Go for the 0.5%, 1%. If you can do 1% on your account a day, I mean that's a great thing to do. Most Wall Street firms would kill to do that, but now they manage so much money, 0.1% a day, it's great money for them because they have billions in their management. So how do you manage your risk? Stop loss. How to place your stop loss, where to place them. Another way to manage your risk is to diversify your portfolio. Because a lot of times people say, I'm going to trade at the beginning, yeah, you want to stick to one or two things to trade. But as you get better, as you understand futures trading better, you want to do, for me, I look at 4 or 5 different things before I take a trade and one. I'm like, where's the best opportunity is? I look, this is at the S&P or NASDAQ. And sometimes I look at all 4 indexes, the Russell, NASDAQ, the Dow, and the S&P. So whichever is giving me the better opportunity, I take it. That's diversification right there. But also you want to go out completely out of that. This is the indices, so you want to go out completely. Sometimes I look at crude oil and gold. Say, hey, if there's anything here in gold that I can take advantage of. Because sometimes you may want to focus on one at the beginning, which is good because you're still learning. But when you try to diversify your portfolio, at risk management, because some days the S&P may not be the best thing to trade. All 4 indexes may not be the best thing to trade. Some of the days I trade soybeans. Some days I trade, very rarely, but I trade other things than the indices. I trade this morning. I mean, actually, I already had made my growth for the day, but I was looking at soybeans earlier. I'm like, oh yeah, look at this soybean chart. As a matter of fact, it's still on it. That soybean's still on it. Let's see. Look at that. So I think I went long around here and then came back and tagged me up for a break-even trade. But I was just, testing some things. But you have to have different things you can trade, not just one thing, because sometimes what's going to happen, you're going to force trade where there's no trade. There may not be any trade today in the S&P. There might be some in crude oil or gold or bonds. And which, by the way, bonds is a great market to start trading because it moves slower. And as a beginner, as somebody that's beginning to trade, you have more time to react to the market changes. Sometimes it does move fast. Certain times of news, sometimes it does move fast. Typically, you get to more time to react with bonds than the S&P or especially the NASDAQ. I wouldn't want to touch the NASDAQ until you really, really season, because the NASDAQ can be very, very, very crazy. Those swings can make you or break you. I mean, look at this swing on the NASDAQ today. Look at those swings. The market open. Let me go back when the market opened. As you can see, it moves a lot. I'm gonna swing back. So I'm showing you this to show you, hey, diversifying and also you gotta know your strengths and weaknesses. Some people, after you trade several, another thing that's good to diversify, after you trade several types of instruments, you're gonna see what your personality fits best. Somebody that doesn't like a lot of movement, you shouldn't be trading the NASDAQ because you're gonna get a lot of movement, So from this swing to here at 210, to 556. That's about 60 points, 55 points. How long did it take for that? 40 to 944. 4 minutes. If you bought right here, which I would have, I'm not saying that in hindsight, because see that line right there? That's a resistance area. I wouldn't be buying right there, but I could have probably buy down here and cover my position before this. But if I go short here, 4 minutes, let's say I waited for this candle to close down. And the next, this dotted line again was there before that. Covering my position around this area, that's 41 points on the NASDAQ. You know how much money that is? That's $800 per contract.
How many points is it per per move, or how many points is the NASDAQ?
And NASDAQ is five per point is $20. Each point has 4 ticks, so it's $5 per tick. That's going to be part of your homework to go and look at those things for NASDAQ and all the major indices. So you can see the Y values is 41. So meaning that's 41 points from that candle closed down all the way to that yellow line, which is really where you should be covering your position, because that blue line is a support from a previous swing. So, and then maybe if you break out trade, you trade below that line again and for a few points. Even that little move, you may look at it and like, wow, this is not much, but this is probably 20 points right here, over 12 points. But if you held on it longer, it'd be 20. So it's matter of fact, I did try to place.
That thing moved like 40 points in 5 minutes.
It moves crazy. You can get a 50-point move in 1 minute in the NASDAQ. From here, 40 to 51, that's 10 minutes. You had about 20 points. So the NASDAQ this is not something for beginners at all, the NASDAQ. You could probably try the YM, which is slower. The YM is much slower, or the Wassel, which is both Wassel, NASDAQ, and the YM. They're all $5 a tick. So, they're a little more choppy, but it's definitely much better to trade those. So this is what diversification is important to know. Hey, you know what? I can trade the NASDAQ today, or I cannot because it's too crazy today. Or I can trade the YM today because it's a little more predictable than the NASDAQ. Or I can trade gold today. If I go back to that same window, at a glance I can look at crude oil. Crude oil today was not too bad. There was not much direction, because when you see the background is white, that means it's really not much direction. When it's green, you want to be buying, and blue, that means it's in transition.
What kind of lines are those? Dotted line? Is that a moving average?
This one?
Yeah, the green dot, or the red and green dotted lines.
Oh,
yeah,
they're not moving averages, yeah.
Those, like that one at the top, the thick red one at the top. That's a moving average?
That's a 50-period moving average, yeah. And the green one here, it's a 15-period moving average. But anyway, so it's good to diversify. Go back to this, because by doing that, you can know which today might not be a good day to trade this or that and trade something else. So that's a part of your risk management. Or when you get to the point that you can trade, let's say, 2 things at a time, you can trade one contract on this one and one contract on something totally different. You don't want to trade one contract on the NASDAQ and one contract on the YM, because they usually move together in the same direction. Well, you can trade one contract on the YM and one contract in crude oil, one contract on crude oil and one contract in ZB, which is the bonds. So you can diversify that way too. You don't have to have one trade at a time, but at the beginning, you want to probably stick to one trade at a time, because it helps you to keep your sanity and be able to manage things better. Any questions about that?
No, I'm good with that.
Now, something that we're gonna pretty much each lesson we talked about, we're gonna talk about this. Trading is one of those things. There's nothing against any other profession. I think that's one profession that if you chose to be a trader, you're always going to be a constant learner. Not only in the books, but in the market itself, because the market itself is the greatest teacher. Because every day that you trade, you're going to have to learn. There's something, either win, lose, or draw, there's something to learn about that trade. There's something to learn about it. Win, lose, or draw. So the learning is continual. You know, how do you learn? Books, online courses, you know, websites that you can get information from. You know, to somebody like me, we're doing a mentorship right here, that you can pick their brain and see how they would have done this, or what was the experience with this or that particular situation. So you get somebody to kind of bounce off ideas from. And believe it or not, your mentor also, as a mentee, you have something to offer. I'm going to be learning some things from you as well, eventually, you know? So, meaning you may look at the market from this angle, and I never looked at it that way before. So, that's basically what it is. And if you don't have any more questions, that'll probably be a session for today, or future lessons. You know, we're going to talk about more strategies and risk management, especially we're going to talk about psychology. That's very, very important, because everything else really, remember we talk about the two-legged stools. You gotta have a good strategy, you gotta have the good money management, and a good psychology, good mindset, how you approach the market. You know, did you trade today, or did you trade Sim? Yeah, that's all. That's all. Close this. Let me stop. And that's all. Stop.